Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 30, maybe even 40 minutes here on Options Guide TV. Today's date is Friday, March 1st, 2024. The markets are rocking and rolling. And speaking about rocking and rolling, I have one of my friends that I love to party with, Dan Sheridan. As promised on Wednesday's show, I was going to ask Dan, what are some of your favorite strategies that you like to teach in your mentoring service? Dan is the founder and president of Sheridan Options Mentoring, but the website is sheridanmentoring.com. And Dan and I have known each other for, it's got to be close to 20 years now at this point in time. And both of us have lectured we've been in the same room quite often, and we've done a lot of lectures over the years, all across the country, actually, not only just in Chicago, but all the way across the country. And I'm going to get into detail with Dan about his favorite trade, but I want to start, Dan, by talking a little bit about the Wednesday show, which I know you mentioned that you actually watched Options Guide TV on Wednesday. And one of my favorite trades that we've actually been kind of focusing on, and I kind of want to get your opinion a little bit about this trade, is we've done on Options Guide TV here over the last, I would say almost, going all the way back to the beginning of the year, we've been kind of targeting the 5,000 mark in the S&P 500 index, just selling a bunch, or I guess it's not selling. You would say I'm buying the butterfly for a net credit, but the skip strike butterfly, where we're always kind of selling it. And on Wednesday's show, I went into great detail to try to show that you're really just embedding a credit spread to pay for the butterfly. And what was fun, and unfortunately, the show didn't start a half hour ago, but just for fun on Wednesday, we did a paper trade, a very short-term one, which is normally not the case. We'll usually go out at least a week in time or even a little longer, where you're going to get 5 or 6 trading sessions. And it opened this morning right at our short strike and our skip strike butterfly. So I want to show this to start with. So let's bounce back out and let's look at the TradeHawk software. And then I want to get into a lot of detail about what your plans are and about your mentoring and all of the people that you have in your community and a lot of the things that you guys like to do on a weekly basis or monthly basis or however you prefer to trade the strategies that you like to trade. But here's my trade, Dan. Okay, so on Wednesday, we came in. The marketplace was right at, and let me pull this up here from my screenshot. Marketplace was about 50. It was just below 5,100 when we did the trade. It was five on the SPX. We were 5,071. My eyes aren't quite as good as they used to be, but 5,071 is where the market was at. We're now at 5,016. We put the skip strike on, so we were down. It was about a 1 standard deviation move away to get to the 5,100. And now the market is powering on. We're up about almost 0.5%, trading right around 21 points higher. And at this point in time, the trade is hurting us, which is annoying to me. We put it on for a net credit of $1.50 to the account. And in this morning, it was actually selling for or trading for a credit. We could have unwinded the trade for that credit. And let me run to the what if calculator inside here on the TradeHawk software and show that this is just an annoying scenario that's going on right now. In that, if you put the trade on, this is where we're heading to on the profit and loss. Okay, let me grab this down. Is we did the trade, we hung out right around here. This is where the market was at. If the market ran up, it was going to hurt us. And right now we came all the way down to this level on this trade, which means we've got a lot of risk if we get beyond right about here, beyond the strike that we actually skipped in the skip strike butterfly. And I guess I want to talk a little bit. One of the things that I love about the SPX is that the juice, the premium just sticks in the option contracts. But right now, that's one of the things we absolutely hate. because we're sitting right around the 51.20 strike where our risk is kicking in on this trade. But man, this option contract, this is basically the one that we skipped, still trading for $7.
Yeah.
And I kind of like I battle with this a little bit in the SPX. It's a love-hate relationship with how the premium sticks around because it makes it a interesting index because you can adjust your trades almost all the way up to the expiration date. Yeah. But then again, you're just sitting here just hoping for time premium to happen, and it's not happening. Time to kill. So your thoughts on the skip strike butterfly and
I like the trade. It's like you like where you're at, and Brian and I were talking a little bit before the show. You love it to be at the short strike, but it's like your mother-in-law coming over maybe a week early at Christmas. Hey, you love your mother-in-law, but it's a little early. And here we would have rather go to the short strike maybe at lunchtime, right? Or maybe a little bit later. I mean, we're happy we're near the 51.10, but right here, you're kind of short, you're short deltas, you're negative theta at this point. So it's kind of like this trade is transforming before your eyes. It was your friend. I mean, you had a pretty good profit there. How much profit? What was the P&L, Brian, from the close yesterday to where we are now? Did you give up any or did you get more?
Yeah. So if you would have closed it out when the market was, and I'm going to go to, let's just do the day chart. Well, I guess we'll do a 15-minute chart here. And doesn't always pull up the best here, but here we go. So on the open here, we're in IWM. That's probably going to hurt us. Let's go SPX. Which the IWM trade turned out really well this week too, which is also expiring today. Did a long straddle in it. I like straddles in the IWM. I don't like long straddles usually, but it worked out this week.
Oh yeah.
So here's where we were at. So we opened like right here. This is our bottom strike, 5,100. Yeah. And we hung in this level. And then that next 15-minute bar, we came all the way up to the 507, 5107 out of the 5110. And that's our short strike right there. Yeah. So this morning, you could have gotten it. You could have put this. And this is one of the fun things about a skip strike butterfly is we put it on for a net credit of $1.50 to the account. Yeah. And now we could have taken it off for about a 20-cent net credit when it was trading at 5,100 this morning. Okay. And now, annoyingly, that it's gone all the way up through the strike. And I would have taken it off. I want to let it run through the strike personally. But, and I've talked about that a lot on the show. But, and here, now we're looking at a net debit of $2.65. So now it's really hurting us. Right. Except if we make it all the way to expiration and we stay within these lines right here, it's a home run. It's going to be profitable. So it's just a real tough trade to do. I don't like to take that risk at this point in time. It's sitting right at the 51.20 level. So I would, if I fell asleep and woke up and this is where the market was at, I'd probably take it off at this moment.
And I think you're at kind of the point of no return with the way the deltas are right now. You're what, about 36 delta short. It's just kind of right here. We're at the highs of the day. You'd love for if things could back off a little bit here, but right now, I mean, the range in SPX right now from the high to the low looks like it's around 50.94 low, 51.21 high, so about 27 points, which is kind of normal for this week. We've had lower ranges. It's been more of a good week for range bound, but right here. This beautiful skip strike, wonderful position.
I would call it beautiful too. Just like all your children are beautiful.
Oh yeah, you're right. But it's turned into a Sybil here. It's turned at this point. It's changed. It's become an angry person right now with these short delts. It's strictly a directional trade at this point.
Yeah, right? It is.
I mean, at least for now. But it's like this is where it really tests your to trade on expiration day. It tests your fortitude. You have to have a very strong constitution. And hopefully while we talk, I'll try to talk it down. Hopefully we can get to maybe 51.15 or 51.14, but you are at that moment of of decision here because of the Greeks.
So to go back to it, when the market opened at 5,100 and it started drifting higher, that's when I would have gotten out of the trade without a doubt. I didn't want it to, especially 51.05 where I'm pointing. At that point in time, you're starting to get scared and you're probably trading close to even, to just take off the entire position. Maybe you're paying a dime or a nickel, but you put the whole thing on for 150. And, I always build these trades, Dan, as I don't look at it as I'm modifying a butterfly. I look at this trade and I talk about it a lot on the skip strike. A lot of people call it modified butterflies. I like to say skip strike because that's literally what you're doing, because you're skipping the strike. And when you do that, I look at it as an alternative to a short spread. And I think it's just a different way to look at it. And on Wednesday's options guy show, I looked at, well, here's what the short spread was trading for, and here's what the butterfly is trading for. If you combine the two of them, you end up with this butterfly and you're doing it for a net credit. The short spread pays for the butterfly.
Brian, let me ask you a question. Could you have, at the end of the day yesterday or at the opening today, take some profit off by turning it into a regular butterfly? So you got the 5,100 you're long, you're short 2 51.10s. What if you would have bought the 51.20s, sold out your 51.30s? You could have probably taken, most of the capital off the table because you would have taken your profit on the credit spread. Then you got this free time bomb, kind of like free shot going into today. It would have been easier. That would have been easier to at least stomach, right? Whereas now you're dealing with the wrath of the credit spread. Whereas at least, taking it from 5,100, 51.10 to 51.30, if you took off that credit spread, then you're in the 5,100, 10.20. Now you've got such little on the table, you can kind of go up for a picnic or something. Do you ever do something like that, or what do you think of that?
Yeah, and I like that, and that's part of the reason why I like bringing someone on the show. And that I'm trying to pull this up. Okay, there we go. I'm gonna have to. Okay, I'm gonna move out of this. We can stay right here, but I'm just gonna exit the full screen for a second. Then I can pull this over. Yeah, this was where it was last night, and I knew we were gonna have this conversation. So the market was at up 12 points, up 0.25% at 50.81, and we could have done. This is the standard trade, so it was 25 cents at that point to take it off. It would have been a net debit of 20 cents. And then and at one point in time, it was 17, so that was stuck in there. But yeah, so you're saying we would take this 51.30 and close it and roll up to the 51.20s.
Right, just put it into a balanced, I would call it a butterfly.
That's a good way. And I love, and I forget that you like to call these short-term butterflies time bomb butterflies. And that's basically
they're directional.
Right, they explode and explode into profit, right? Yeah. And interesting way to do that. All right. Yeah. So I love that trade happened this week. Like I said, very rarely will I do well, this would be a skip strike time bomb butterfly, right? That's a long URL, but it's
nice. I mean, I like the skip strike, Brian, because I like it because you've got that credit spread, and the credit spread is carrying quite a bit of delta, and you're basically saying, hey, I like the trade, but I want to get a little bit of long delta against it, a little bit. And I think that's a good trade. And then you really only have risk in one direction. So I think that's a good trade. It just, on expiration day, it becomes a challenge. I mean, what's nice is since we've been talking, Brian, we have backed off from 51.20. So it's a nail biter, but it definitely is like babysitting a colicky baby. If you're gonna keep this on, you gotta pay attention now to this.
Yeah. Yeah, I'd like to know that we can move the market down by our conversation.
I know. We have such power over the market, don't we? Yeah.
All right, so that's enough about me. Let's go back out. Let's zoom out of the TradeHawk software for a second.
All right.
And there we go. And let's talk a little bit about. I know you. It's amazing to me how long you've been mentoring option traders. Bluntly, I don't know if I've known anybody that has just had the passion that you have to try to just stick with all of your students, as you like to call them. They're still students to you, right? Even if they've been in your system for about 25, 30 years. You're every single week, you're tweaking things, you're managing things. And what are some of the trades that you like to talk about with your students, week in and week out?
Yeah. Well, let me just one comment on what you said. To me, for me, the pleasure has been working with the student. It's a community. I'm Irish kid from Chicago. I like people. And I mean, being in the pits for many years, it to me at times, from someone who likes to talk a lot, it was distressing. For 7-8 hours, you had to focus every second on, making a dollar or not losing a dollar. And it was a very intense environment. And so to me, working with retail people, and really it's been a partnership, because you're working with all these smart people. And whether we take a butterfly or calendar or iron condor, when you get 100 people selflessly working together, you build a better chair, right? Just like, and you learn from everybody. I learned from you, Jimmy Bittman, and you take into account, and it's really to help you take what you learn and build a better chair. So I always tell people, and I mean this sincerely, most of the good ideas that have come out of Sheridan mentoring have been from students tweaking it. I might have thrown the paint at the wall, but other people say, Dan, move the paint this way. So together we build a better chair. And that's really how I look at things. But it's more for me just to work with people on something. Like you said, Brian, I see the passion with you. I enjoy doing this, but switching over to the trades, for me, trades that we might have been doing 6 months ago, because of volatility, because market conditions, we might not be doing them as much. For most of March, if you take January of 2022 to October of 2022, that was one of the longest downturns, in the history of civilization. I'm being dramatic here, but the COVID correction was 5 or 6 weeks. From January 2022, we were down for 10 months, and people were like freaking out, because most people, this has been, the last 10 years have been slow upward trending market. And so in that January period, we're going down, and people like, I haven't made adjustments on the downside in 10 years. And so you've got that.
It was hard to make that adjustment.
Well, so we were doing a lot of certain types of butterflies because as the volatilities go up, certain butterflies that are stronger for the downside, like a balanced butterfly, where the deltas are too short right now, you could do them. But right now we're in a historically low volatility environment. So naturally we're looking at, for next week, if I had 3 trades to put on, and we'll talk about today, one, short term, I like to diversify the duration. I like to diversify the strategy, the deltas, different things. So I would put on a 4 to 8 day duration trade called a combo, maybe on Monday. And I think that's what we're going to talk about today. Then on Tuesday, I would put a 22-day butterfly, and we have that modeled. And then Thursday, I would put on a calendar. So those are the types of trades that we would put on, but based on the VIX and based on how fast the market's moving. The big question is this: are we range bound or not? If we're range bound traders, right, we need some type of two-way, some type of range bound, not really big candles to go in. But if we're but we back off, it's like going in, the old analogy, Brian, of going in the ocean. You take your family and you say, I'm going swimming. Well, if the lifeguard says, hey, we spotted a jellyfish 20 feet out, hey, go to the library, go do something else. And so to me, like the NVIDIA day or whatever, big event that could be risk on for a range bound trader, hey, go to the park. We have 5 days to trade during the week. Be a little more selective around news events or things. And so it's kind of, avoiding the dynamite. But do you want to start with one of these, Brian? Or
and I think what I'm going to start by showing right now is I'll show the 2 trades that you talked about inside the options playbook, and then we'll run to the TradeHawk software and the options grid.
Perfect.
And we'll look at how we might put them on, and then you would talk about how we might adjust that trade relative to what's going on in the market.
Perfect.
Okay, and this is a live show, so if you are in the YouTube platform and on the Tradier side, or the Tradier YouTube is a better way to say it, and you want to ask Dan a question, feel free. We're happy to try to address any questions that you may have during the show. Okay, so let's come back out and let's look at the options playbook. And I'm going to mention the 2 trades that you showed. Okay, so one of the things that I want to kind of point out here is Dan's talking about on the downside using puts and setting up a long calendar, also known as a time spread. I probably refer to it as a time spread more often than not.
Oh yeah.
But the thing that I find interesting here, Dan, is, and a lot of people have said this, is that, or have used this kind of analogy, is that this is the poor man's butterfly. It looks very similar to the butterfly, which I'm also going to show you here.
Absolutely.
But we have 2 different expirations, which kind of makes the lines wavy whenever you have 2 different expirations in a profit and loss graph. Now, the other side is the long call butterfly. And so now the market's in the middle, right? We got a trade down on the bottom side of things. Now we're going to put a trade on the top side of things. And this is the butterfly, and this is the long call butterfly. So may I ask, and I think I know this answer, but why not just do 2 butterflies?
Instead of the combo.
Why are you doing the puts on the downside? And I think it has a little
strictly
bit
to get for a lot of people to get the Vega. There's 2 main risks on any range bound trade: price and vol. There's a lot of imagination, like the moon or the Cubs or whatever else, but it's really volatility and price. So this combo takes out one of your enemies. It takes out volatility. And now you just have to deal with one enemy, price. So it kind of neutralizes the volatility risk. And you might say, well, Dan, VIX is 13. I want to be a little more long Vega. And that's fine. But this is just something I think over the last 8 months we've been doing pretty regularly. And it's just nice to have one less headache. You don't have to deal with the volatility risk.
Right. And that's one thing about a calendar, like a lot of people that look at a calendar, is, first of all, if you are long a calendar, that means that you have sold a shorter term option and bought a longer term option.
Right.
As expiration approaches, the short term option in your mind, if you're correct on your forecast, is going to go away. Right. But you're left with a long option. So implied volatility in that instance, you want to go up, and that will help out your trade overall. Yeah. On the butterfly, the exact opposite is true, right, Dan?
That's right. With a butterfly, now this is the way I'm setting it up is a directional a calendar on the downside, and if volatility usually goes up when SPX goes down. So it benefits that's why I'm placing the put calendar on the downside, and then the upside, SPX goes up, volatility goes down. So I'm placing this directional butterfly on the upside.
Yeah, and I like that. So let me just reiterate, because I want people to know, if you're doing that calendar, ultimately, and you get it right, you're really just long a put. And if you're long a put, you want implied volatility to go away. Because if you're correct on your forecast on a calendar, and I don't care if it's call side or put side or whatever, your ideal situation is that you lose all the time premium in the front month, and then you are just long that back month. Now, you're going to get out of the trade prior to that, but that helps you visualize that you want implied volatility to go up. And I love that. You know what, Dan? I don't know if I've ever really thought about that. Instead of doing 2 butterflies, but that answers the question. You're trying to get the forces of the SPX working for you and taking different variables out. I really like that. So let's set one up. Let's do it, because we got a few more minutes here. We're going to go a little long today on Options Guide TV, but let's light the scandal, as they say.
So if you do the put calendar at 50.85.
And what I think you said, March 11, March 8th, right?
Yeah, March 11, March 8th, 50.85 put spread. This is about a $550 total trade, and it's kind of got a Batman look to the graph.
And what strike am I? What strike am I?
50.85 on the puts.
50.85. Okay. And this is so the March 8th, which I'm highlighting here. 50.85 I'm selling. So that's going to add the leg in our spread. Then we're going to go to the March 11th and we're going to click on this one and we're going to add that 50.85 and we're going to buy it.
Yes.
And all right. Wow. We got some price in that one. Look at that. 56 bucks on that baby. All right.
So that's like $2.30 for that calendar.
I'm showing it at $3. Is that what you said?
Yeah, I mean mine is showing about $2.30, but it could be how the the mids are. Are you buying the March 11, selling the March 8th puts? 50.85.
50.85. That's a sell. And buy 50.85 on the March 11th.
In the puts, yeah.
Oh, I'm on the call side of things.
Okay, put.
There you go. Whew.
Okay, yeah.
Yeah, that would be bad if well, I know that you're on the Eastern time zone. You're no longer in Chicago.
Yeah, Eastern time. Yeah, so a little. That's right. Well, are you Eastern or Central in North Carolina?
We are Eastern time in Charlotte, North Carolina right now. And I know you're not that far away. We're going to have to get together and do lunch. That's what I did wrong. Okay, so I clicked on the call side of things, talking about the calls, and then we go here. Yeah, there we go, 2:30.
So it's puts. Okay, and then now we do a butterfly on the call side.
Now, are you doing this as two separate trades?
Oh, yeah. I would just do one, and then within 30 seconds do the other. It's pretty liquid vehicle.
Yeah. Okay. So 2:30. That's that trade. And I'm going to send that to the what if calculator. Let me do that just so that we have it loaded up somewhere. And it's going to pull me there. Then I'm going to have to come back.
Okay.
So now let's go back and we'll clear this out. And then we're going to go to the March 8th on the call side of things, right, Dan?
Yeah, March 8th on the call side. So as of today, this would be expiring next Friday. So this is like 8 days. And we're going to sell the 5150s a little bit ahead of the market.
Okay. And then go 25 points down, right?
Yeah, 20. So 51.25, 51.75, and this should be around 320.
Okay. And we'll sell these two. And now I'm on the right side of the thing, and we got this, and boom. Okay, 320. Yeah. And that's a butterfly.
Yeah, that's a fly. And then can you combine them for the graph?
Yeah, I'll send it to the what if. Let me do this.
So it's about a $550 trade, and it's an 8-day trade. We're looking probably 80% be out of this by Tuesday.
Oh, wow. Okay. So right now I didn't go that route. I should have kept that up and running, but let's look at this. So this is what I'm saying. Now we're on the market is right here, 51.4237. That's where the market is at. And look at how the put
button. SPX, I've got 51.16.
Oh, right there. Right. 51.16. You're right. You're right. Yeah. So that's where the break even is at. Okay. So we're 51.16. And if I scroll in on here, and we'll zoom in a little bit on this trade, but what looks real interesting about the trade is that once again, here's the put side, the calendar, and here's the call side. Here's the butterfly on the call side. Look how similar they are, except the only real difference is we got a bendy line in here because we're going into that expiration date. So what's your approach now?
Yes, so here's the game plan. The game plan is
here's where the market is 51.11, which 16. We're still not in our range of our skip strike, but all right.
And again, I'm giving you the game plan on the combo, right?
Right.
So the combo would be, if you can visualize this, folks, it's the SPX is at 51.16.
Right.
The butterfly is centered at the 51.50 strike, 35 points up. The calendar is focused at the 50.85 strike, about 31 points down. And we're looking to be in this thing till Tuesday. So throwing a little bit of fire on this thing, you say, what are you looking at? If the expected move, do you talk about the expected move a little bit?
Yes, I have. And the one thing that's kind of nice here is that the software highlights that expected move with the gradient variance.
Yeah,
right. So this is you're between 16 and 18 delta right here.
Okay.
So you're right in between these two strikes.
Yeah. So to me, when I look at expected move, I don't look at expected move to expiration. For me, I think
Right.
that it's useless unless I'm going to be in it till expiration. But if I'm going to be in a trade, generally 20 to 25% of the duration. So on this trade, I'm looking to be out by Tuesday, possibly Monday, but let's say Tuesday. The expected move from now to Tuesday, if I did this right, is about 40 points. So this, I like a double structure, this combo or a double calendar or whatever, when it's shorter term, because when you're a shorter term trade, you need room. And this thing can handle 40 points, no problemo, right? I mean, if you go up 40 points, it looks great. And if you run it on, Tuesday's date, we're looking for at least 10% on this. So if this is a $550 trade, 560 for every one contract, I look at $55. So if I did it 10 times, it'd be a $5,000 trade. I'm looking 500. If I do it one time, it's a 500 and some dollar trade, $50. But what I like about it is you have plenty of room. I mean, for a short-term trade,
right,
antlers always go up. Oh boy, short-term, blah, blah, blah. But I say, hey, be patient. Look at the trade, right? Do you have enough room? You've got a ton of theta on this trade. And the only adjustment I would do, especially on a short-term trade, I don't like adding capital to it. The only adjustment I would consider would be if we went like 10 or 15 points past the short strike of the butterfly on the upside.
Okay, so we're up in this range.
Yeah, if we get up to 5160 or something, 5165, 5160 or so, I would just take off the put side, right? So I take off half my capital. And if we go down on the downside, 10 points under the short strike of the put calendar, the strike is 50.85. If we go to 50.75, just take off the call butterfly, right?
Okay.
Because that's our, when we start thinking 8 days from expiration or 4 days from expiration, it's the stinking price risk. Forget volatility. It's price risk that you have to deal with. And I think having a plan like that where I would reduce my capital in half, and I'd only do like an 8 days or less. I'd only do personally one adjustment. If the alligator starts wrestling with you and it gets too tough, move on. Right? Don't start getting 4 adjustments and turn this into a mess. So, but I think these have worked. I've been doing these about a year. I'd say maybe about an 80% win rate on these things. Now, there'll be a few weeks like an NVIDIA or something where we're not in Dodge. If we think there's a big, like a Fed event or something, I may either try to get it off before if I have a little bit of profit. So we're not just recklessly putting this on regardless of what's going on in America, right? But I think that combo, usually I'll do it. A lot of times I'll do it, Brian, on Monday, like this Monday, because I think next week, relatively a light news week, relatively. And so I might put it on Monday with Friday expiration. Whereas today we're looking at.
As opposed to having the weekend, right?
Yeah, I normally would put it on.
Most market crashes happen on a Monday.
Right. I would normally, and you're right, I would normally put it on Monday after we've been open a couple hours for either Friday's expiration, that'd be a 4-day trade, or the Friday after, which would be an 11-day trade. But I would suggest to viewers, if you like something like this, paper trade it for a couple of weeks, get it in your bloodstream a little bit, see how just see how it moves, and then you kind of go from there.
I agree 100%. And I do agree on the adjustment thing. And I've said that many times. I've had a lot of questions where people will come to me and say, hey, I put on this long call spread or this long put spread, and right now, I'm almost going to lose the maximum. How do I fix the trade? And I'm like, well, you can't drive a car off the cliff and take it to the mechanic and say, please fix it.
Right. That's right.
So, there's a time where you just give up. And that's a big thing, is just that you have the plan and then you stick to the goals on the plan. And I really, especially when you start talking about the SPX and the premiums and the bid-ask spreads, they will kill you if you just keep adjusting and adjusting and adjusting.
And one other thing, Brian, real quick. So you made a good point. On every trade, I have a profit target and a max loss. The adjustments, I think people have the wrong. idea on adjustments sometimes. They think adjustments gives them the privilege to lose as much money as they possibly can to throw good at bad. And I'm like, if on this trade, a $550 trade, if I'm looking to make $55 per unit, right? My max loss has to be somewhere in the neighborhood, right? So maybe I could lose $70, right? Maybe 12 or 13%. But that's with adjustments without, because if you're going to have a 70, we try to shoot for a 75% win rate on most of the probability type trades we do. So that really the goal is you're going to get a good win rate. Can you keep your losers under control? And I think that's a virtue, a characteristic called discipline, right? That when you're down $75 on this, I don't care what the story, I don't care Fibonacci, Gubernacci, Habanero, take the stinking thing off, live to play another day. Because if you're going to put 50 or 75 of these on every week for the next year, it really comes down to keeping your loser under control. So it's not going to come down to somebody, are they smart enough on the Greeks? Are they smart enough on the butterfly? They can all read an account. When you're down, you try to keep your losers not too far from your winners, because how many people, Brian, have you talked to?
Keep your enemies close, right?
How many people have you talked to, Brian, that have said, Brian, I put on 50 trades. If it wasn't for those 3 trades, right, I'd be a contender, as Marlon Brando would say. But I say this, I always ask people, I say, look, on those 3 trades that you lost much more than you wanted to, could you have done something? Was it the market or you being a stubborn mule? And they said, Dan, I could have got out at my max loss, but I didn't, either because I thought the market was come back, or I was talking to the neighbor, or I was cooking hot dogs or whatever. So this is really where the rubber meets the road on risk management is, hey, keep your losers under control. That's something that's controllable, right? If you said making money was based on how do I read a Head and Shoulders or a Fibonacci, I couldn't do it, right? But if you tell me don't lose more than $75, if you can read your, the trade hawk, P&L, boom, you're okay. Anyway, that's my Vince Lombardi speech. That's it.
And I loved it, and I love all the analogies. We used to take the over when Dan was lecturing, and he lectured for about 15 minutes in the crowd. He doesn't know this, but we used to take the over under on the number of analogies that he would have in the next 15 minutes.
Just so you know, they've gotten worse over the years. I used to do much more.
I did want to say, and I wish, are we going to have one last hurrah at the Chicago Bleacher Center?
You know what? Brian.
But let me finish this, because here's one of the things that I love. I've always done that for many, many years. It was the one time a year that I got together. I saw a lot of good friends from the Chicago Board Option Exchange, or the CBOE Global Market now, which is just weird that they named it that.
Right.
But with that said, I love the fact that your students actually were some of the main lecturers. We'd have, just a all-star lineup. And that, a lot of the people that stole the show were your own students getting up and lecturing. And I always love it.
This is a craft, right? And you learn from, and we do that in our community still. It's just, you get different craftsmen. They look at the world differently. That's what it is. You just want to hear different people. Like, when I was talking to you, I've been talking to you, I'm like, hey, what's Brian doing? And I watched yesterday's show, and then I thought for about a half hour on the skip strike butterfly. So it's, you're constantly kind of reprocessing this stuff. Right. So it's good. And that's like with Sosnoff yesterday, when I was talking to it's just that whole different people, different thoughts. So
right. And and everybody coming in, and the more you talk, and like I literally, that is the first time, and I can't believe how many years that we've been trading alongside of each other or bouncing ideas off, where I really thought about doing I've heard of double calendars all the time, but on the put side of things, why not get vol on your side? That so makes sense to me.
And we do a lot of those. Like we did the combo today. We do a lot of double calendars, but again, you got to be very careful with the volatility. If you do double calendar and VIX is 15 or 16, and we drop 2-3 points, you're going to have to hold it till expiration, and then you have a white knuckle situation.
So the only major news that we got coming up next week, and I'm kind of surprised because yesterday I had the financial news networks on all day long. because nobody's really talking about the fact that we just keep kicking the can down the road for making a budget for our government. And, that's still a risk. And I'm surprised to see the VIX hanging around that 13 level. And I guess they've done it so many times that they just assume that they are going to kick the can down the road again.
Yeah.
And but there's a chance of a partial government shutdown. And that's the only thing that I really see as a scary thing that could happen next week. But I would be aware of that. I would keep that in mind.
And isn't it Thursday or Friday, the non-farm payrolls, I think, Brian?
Yeah, and so we still got, the economic data, and there's always a plethora of it. But this is the wild card. This is the black swan.
Yeah.
Even a partial government shutdown would really spook the markets at this point in time. But markets have been strong on Options Guy TV. We've been long. It was crazy. We did a deep in the money call option at the beginning of November in NVIDIA, and that 3 lot of calls, is up $100,000.
Wow.
Just by buying a 3 lot of 80 Delta calls.
Well, Brian, you think about it, when you just, if folks, forget technicals just for a second. If VIX is 14 and under, right, we're not going down. Because, if VIX is 12, 13, or 14, that means SPX has been going up, right? So you could just say, when should you start worrying? When should you start worrying? You don't need to worry unless if VIX is under 14, we're going up, right?
Right.
If we hit 15 or 16, then okay, now we can revisit the downside. But right now, you're right. It's still, as much as we want to be contrarians, and there's a little bit of that in all of us. I always say the market can be solvent. The market could be irrational longer than we can be solvent, right?
Yeah.
And so I think it's just accepting this is what the weather is right now. Whether we all can say, well, the market's been up 25% in the SPX in 4 months. It's got to go down, and it will go down, but not when you want it to go down, right? Anyways.
And the historical vol and I'm just kind of looking, I don't need to go to the software, but on the software, I'm seeing the historical vol around 10% in the SPX. So that does have something to do with where the VIX is at. A lot of people ignore that fact, but yeah, the actual volatility of the marketplace has been kind of mooted.
Yeah.
I didn't say that word. Oh, that hurt. I hope my tongue's okay after that. But with that said, right around 10%. So that's going to actually keep implied volatilities a little bit lower too. Actual does matter. And so we have one question here. Let's put up Wayne's question if we can. Wayne is a longtime listener and fan of the Options Playbook. So Wayne says, is there an index for the QQQ that is cash settled that we can do 0 DTE trades on? I don't. So we're talking about the NASDAQ and 0 DTE. Does the NDX have? I think the NDX would be your trade, Wayne. I think that's what we'd be looking at. They have a lot of different expirations in the NDX, but it's a much bigger index. So the QQQ is a stock or an ETF. So yeah, I guess the answer is that's an easy one. I didn't even need Dan's help on that one.
Yeah, I like Brian. What do you think? For zero, when I do 0 day stuff, I normally will just do SPX. How about you?
Yeah, and I do too. That you need something that's extremely liquid.
Yes.
And the SPX is NDX. I wouldn't mind, but no, for some reason I just hang in the SPX. Maybe it's the old CBOE days or whatever, but I've stood in that pit many a time, so I just feel more comfortable in the SPX.
Didn't SPY recently, am I right on this, adding that you can do the daily, you can do the 0 days in SPY? Is that correct?
Yes. Well, and they've kind of been around because the SPYs match the SPX expirations. Right. So they've had Wednesday expirations forever in the SPY because of the VIX options.
Gotcha.
And now, like if you look at the expirations right now, we have a March 1st, March 4th, March 5th, March 6th, March 7th expiration in the SPYs. And then there's a few ETFs out there that have 0 days, but they're not and they're not every single day. The 0 day means that they just Some of them just have a Wednesday expiration, and some of them have a little bit more. So it's a little bit convoluted as to what 0 day really means.
Right.
Right.
But I think, don't you think, Brian? I think for a lot of viewers, if you're new to the 0 day or you're trying to perfect a strategy, do it in SPY if you can, just because it's cheaper dollars. Once you get a little, once it's like you're starting to make a little bit of money on it, then you can move to the big guy. Right.
Yeah, that's true. That's true. But there is the tax advantages of the SPX if you're not in an IRA account.
Yeah.
And it is. They're real. They're real. I don't want to get into too much detail, but I also love the fact that they're cash settled. So, for example, the Skip Strike Butterfly, I'm more apt to just let that ride today. Right? If I had, let's say I had a 10 lot of Skip Strike Butterflies on that we talked at the top of the show, I would leave one out there.
Oh, I agree with you. Yeah.
Right. I would leave one out there and I'd be more apt to do that in the SPX because everything's cash settled.
That's a good point. Yeah. Good point.
There's a little bit of that. And Kevin's asking a little bit about being a pro member with Tradier. Kevin, I'm going to refer that to the actual customer service desk. But yeah, it's available to you. It's that simple. But I'm the options guy on Options Guy TV. I don't work on the customer service side of the Tradier platform, but I do love the platform. And actually, Dan was mentioning that he was down on the floor when Lex was down on the floor back in the day.
Yeah.
And I don't want to say his last name because I might butcher it like I just did, but Gesundheit on the end, right?
Yeah.
Yeah. But yeah, in the day, and you talked a lot about the volatility and all the neat things about the TradeHawk software in general.
Yeah, I think it's. I mean, I like it a lot. I mean, it's.
I like the order entry. I like the way the chains are. I really think it's extremely simple to just click a box and it highlights the spread. That's one of my favorite things about the software.
I like that. It's got good analysis page, and I like the fact that there's some volatility stuff that you could tweak in there. So it's, again, I figured because of Lex, it's going to have all that stuff under the hood of the car.
Yeah.
Because of his background, which is good. And that's what you want, a little more meat. So
yeah, and I agree.
Kudos, as they say. Kudos. Yeah.
All right. So we have one more question from Bruno, and I think this will be our last question. Let's put this up. Okay. What experiences have you seen consistent returns with put only or call only OTM options?
How would you interpret that question?
Yeah, well, Bruno, are we talking about, and this is a big one, are you talking about buying calls and buying puts, or are you talking about selling them? And I guess we can try, one of the biggest, and I'll just address the buying of call options. And I actually, on Education Monday, which was the most recent Monday market holiday that we had, yes, buying. Okay. I talked about buying in, at, and out of the money, and that was actually a tape show that we put out on while the market was closed. And, if you're buying in, at, and out of the money option contracts, you really have to have a plan on how you want to address them. And in one of my white papers that you can actually get on optionsplaybook.com, we talk about just buying out of the money options as how hard that is to do over and over again and be profitable. In the paper trade portfolio, which, by the way, Dan, this has a full-blown paper trading portfolio in the TradeHawk software.
Yeah.
But you don't get SPX quotes just because you got to pay for them, right? In the paper trading,
right.
So, but that's where we put together, Bruno, our portfolio of deep in the money option contracts. And we have 5 different underlyings, and we're literally using it as a surrogate for buying the stock. And Dan, I think you guys still do you call this in the community the good old fig leaf?
Oh yeah, I won't desert you, Brian.
All right.
I mean, it's on diagonal, but I call the fig leaf in honor of my buddy Brian. Yeah.
Because I named that strategy in the options playbook, and it seems like it's taken off. If you do a Google search for it, you got to be careful. You got to put in option strategy.
Yeah.
But,
hey, Brian, can I say one thing to Bruno?
Yeah.
If you're in the world of, just again, some people are better at spec trades than others, which is buying out of the money calls or puts. But if you want to last longer in the business, right, and contribute less to the market maker pension fund of America, I'm joking there, my bad humor, but I would look at, again, let's say Bruno wants to buy puts, he thinks the market's going to fall off. I would give up some of my ideas of grandeur and say, instead of buying a put, buy a put vertical debit spread, or buy a, once you get a little more experience, buy an out of the money butterfly in the puts, buy an out of the money call calendar. Much, I think, more conservative ways. When you buy a put out of the money or buy a call out of the money, life can get difficult, right? If it doesn't, how often, Bruno, do you buy a put or a call, the market obeys you immediately and goes your way? Zero, right? So if it takes 3-4 days, the put Bruno bought for $4 is now at $2.50. He's starting to sweat a little bit. I'd start with a vertical or something, at least unless you're very good. I mean, if you're very, very good, you got the Gubernachis and all that stuff down pat. But I use for my directional plays, because I'm not that good at technicals, I'll always use a vertical debit spread, or my number one choice is a out of the money butterfly, because it's more forgiving. It's the best yield out of most of your directional plays, but there's some fine tuning there, right, that you have to talk about. But anyways, good luck, Bruno, in your pursuit of.
Yeah. And as always, when Dan Sheridan is involved, we go a little bit longer than normal.
I am sorry.
No, but I love it. I absolutely love it. What a great conversation. I really enjoyed this. I think I'm going to, at this point in time, we'll say, Dan, come back again. All right.
Would love to. Good to see you, Brian. And I someday want to visit Brian's little house there that's in his backyard. Yeah. I want to see that sucker. I want to see that.
So what Dan's referencing too, and a lot of people might not know this, and actually we're going to be going to a green screen here and kind of upgrading a little bit, but I did build a tiny home. I had a shed in my backyard, a 16 by 20 foot shed, and I actually turned it into a tiny home. And right before COVID hit. So I got really lucky. So it became my office very quickly.
That's neat.
What ended up happening. So, all right, everyone. Well, that's it. That's it for this episode. Thank you, Dan, for coming. Please, if you're on the YouTube channel, please click subscribe, ring the bell so you get all the alerts for the next edition of Options Guy TV. And we'll see you this Monday at 11 a.m. Eastern time. And I guess our paper trade for this week, we'll look at how I'll take screenshots of what Dan did, and we'll just follow the trade. Well, that's what we'll do. So good, clean fun, and we'll see you Monday. Thanks for coming, everyone.
Thank you.